Welcome to the Investing Insights podcast from Morningstar.com. In this week's podcast, we continue to cover market volatility and coronavirus concerns with Ben Johnson exploring how ETFs might behave and affect the broader market. Then, equity analyst Kevin Brown provides insights into buying opportunities in hotel REITs. Next, how investors in Asia are reacting in the ETF space. Andrew Lill looks at our take on the market. And finally, we see value in travel firms. Let's get started. First, Ben Johnson explores how ETFs might behave and affect the broader market in this serious market downdraft.
Hi, I'm Christine Benz for Morningstar. Some market experts have worried about how ETFs might behave and affect the broader market in a serious market downdraft. Joining me to share some perspective on that issue based on recent market action is Ben Johnson. He's Morningstar's Director of Global ETF Research. Ben, thank you so much for being here.
Thanks for having me, Christine.
So Ben, let's talk about what the concerns were, but specifically I want to look at recent market action and talk about whether any of that has shown itself in the recent days as we have seen a significant amount of market volatility.
Yeah, I think it's important to go back and remember that in recent years we've seen everyone from academics to famous hedge fund managers fan these fears around ETFs as, in one case they were labeled weapons of mass destruction. And what I would say is that in recent weeks what we've seen is yet another proof point that couldn't be further from the truth. We specifically, during the week of February 24th, saw record dollar volumes in terms of ETF trading. ETF trading as a percentage of all equity trading in the United States rose to nearly 40%.
Wow.
Now, what does that mean? That means that investors of all stripes were increasingly using ETFs to react to express their views on all of this information that was coming to the market across equities, across fixed income, across commodities, you name it. And what we saw was a very efficient and very orderly process under a stress environment, and again, record volumes. So yeah, it feels like if ETFs in the past 2 weeks haven't sort of passed the test, they're never going to pass the test in the minds of those that think that they might be weapons of mass destruction.
Okay, so let's talk about some examples. Are there any funds where you think it's sort of a good example of how, well, this vehicle worked basically as it was intended to?
The best example of this is iShares' flagship high-yield bond ETF. The ticker is HYG. So what we saw the week of February 24th in this particular ETF was record volumes. At one point, we saw its share count, so the amount of shares outstanding in this fund, reduced by nearly 25%. So massive redemptions in this fund. And from point to point, the fund performed exactly as advertised. It tracked its index absolutely bang on. Premiums and discounts, the difference between the fund's price and its underlying net asset value, stayed well within normal ranges, and it facilitated the ability of all different types of investors to express their views on a basket of junk bonds that was trading back and forth between them like a stock all day, every day, through one of the most tumultuous periods we've seen in the market in recent memory.
Okay, let's talk about what investors can do to protect themselves in periods of extreme volatility. Say they're exchange-traded fund investors. Are there any sort of good hygiene practices that they should use to ensure that they're not somehow caught up in something that they didn't intend to happen with their portfolios?
I think investors, especially in these times, should never forget what the ET in ETF stands for, which is exchange-traded. These funds trade on exchanges like stocks. So investors should be careful, especially during volatile market times, when it comes to transacting in ETF shares. And if there is one thing I can say with respect to ETF trading best practices, it's to use limit orders. When you use a limit order, you ensure that you'll get the price you want, nothing different. If you use a market order in volatile times, you run the risk of getting a price that you might not like. So be careful when it comes to trading ETFs. Use limit orders, and if you don't have to trade, simply don't trade.
Don't do it. Right. Ben, it's always great to get your perspective. I know you and the team will be keeping close eye on what's going on with ETFs if we continue to see volatility. Thank you so much for being here.
Thanks for having me, Christine.
Thanks for watching. I'm Christine Benz for Morningstar.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Now, why hotel REITs look like a buying opportunity.
Hotel REITs have recently sold off due to headwinds created by the coronavirus. While the travel restrictions and consumer fears of the virus might create a major short-term headwind for the hotel industry, we think that this could be a buying opportunity for these companies. Even if the coronavirus eventually has a negative impact on 2020 RevPAR, we believe that companies would be quickly rebound in 2021. Our recent analysis of the hotel industry, we found that hotel revenue was highly correlated with the growth of the overall economy, and that the share of the economy's budget spent on hotels rose over time during periods of economic growth and fell off sharply during recessions. If the coronavirus ends up being a relatively small event and the U.S. economy continues to grow at a modest level in 2021 and beyond, as we are currently assuming, then hotel industry should see growth in 2021 as the industry rebounds and continue to produce modest growth through the end of the current cycle. However, if the coronavirus triggers a recession in the U.S., then we expect the hotel industry to see several quarters of negative growth. In a recession, the first thing that many businesses cut from their budgets is travel, as they look to cut unnecessary expenses, and consumers fearful of losing their jobs cut back spending on luxury goods like travel. Even as the economy recovers, historical evidence suggests it takes years for the hotel industry to return to the level of spending seen prior to the recession. The risk of the virus causing a U.S. recession should keep risk-averse investors on the sidelines. However, if investors believe that the U.S. economy will continue to produce healthy growth despite the flu fears, then we think that the hotel REITs can be purchased at discounts to their long-term fair value estimates.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Morningstar's director of ETF research in Asia talks about how investors are reacting in the ETF space.
Welcome to the Morningstar series, Ask the Expert. I'm Holly Black. With me is Jackie Choi. He's Director of ETF Research at Morningstar in Asia. Hello.
Hi, Holly.
So, plenty to keep you busy over the past few weeks. What have you been seeing in terms of where investors are putting their money or taking their money from in the ETF space in Asia?
Yeah, I think the big topic we're talking about here is the coronavirus, and interesting flows, sort of direction when it comes to ETF market, investing into the China equity market, because what we saw was that right at the beginning of the outbreak, we saw quite some outflows from the onshore equity market or offshore equity, Chinese equity market, from all over the world, basically, Hong Kong domicile ETFs or US domicile ETF or European domicile ETF. But after sort of a month into February, we saw like a sort of change in kind of direction, where we saw offshore equity, offshore Chinese equity, started seeing some inflows back into these ETFs. But for the onshore Chinese equity ETFs, we still see quite a bit of outflows.
Okay, so that was like the initial reaction to the first announcement and the panic, and then people realised that maybe shares start to look cheaper and then they buy back in. So these flows are quite an interesting way to monitor how investors are feeling.
Yeah, I think it's kind of like what we are seeing from the retail market as well. People are panic buying at the start and then being more calm afterwards.
Okay. And I think what's interesting as well is people haven't been selling across the board. Some areas of Chinese ETFs have been seeing inflows and some outflows. Are there particular areas?
Mm-hmm. Well, as I mentioned, the offshore Chinese equities are kind of having the outflows are sort of on a front-loaded basis and started seeing inflows in February. But for the offshore equity market, we are seeing kind of outflows since the outbreak and towards February as well.
Why do you think that might be?
Well, I think there are two sort of aspects. Number one, for the offshore equity market, it's more of the international players that are investing into these products. So we're seeing like people on top of the news and looking into the markets and reacting sort of faster. When it comes to the onshore Chinese equity market, one aspect is we haven't seen the market reacting as quickly as the overall market, because if you look back at the equity market itself, we saw because like of the onshore Chinese equity market was closed, having an extended Chinese New Year holiday until the 3rd of February. So a lot of the reaction was kind of like delayed as compared to the outside world. So there are quite a bit different in terms of like people willingness in buying into the offshore versus onshore equities.
With the onshore as well, could there be a slight change because the government's more likely to intervene there, and there are the limits on how much shares can fall in a single day?
Well, I think like when we are looking at the market after the onshore equity market resumed, the fall wasn't like big enough to hit the limit anyway, and very quickly the market came back up. So it wasn't quite because of the limits, but it's more of like the equities going back into the onshore market, sort of supporting the market.
Okay. So after the initial panic, the Chinese stock market has actually recovered all of its gains already. What are you expecting to see over the next few months as this plays out?
Well, it's pretty hard to sort of predict the actual market. I think what we should be sort of focusing on is the development on a global basis, because this is not just about China now. It's about how the global equity markets reacting to what's happening with the virus situation going forward.
Okay, well, thank you so much for your time.
You're welcome, Holly.
And thanks for joining us.
Now, 3 takeaways and advice on staying true to your goals amid market volatility.
Once again, stock markets are dominating the headlines as concerns about the economic impact of COVID-19 draws the focus of investors from the long-term horizon to the here and now. Recently, the OPEC nations are preparing for a potential oil price war, which has added to the uncertainty in markets desperately looking to recalibrate fundamental implications. In these situations, it is prudent to ask how your investment manager is responding, and on an individual basis to consider what should be your response. It is natural for us as humans to react to alarming headlines and to panic when events such as this outbreak occur. However, we believe that taking a more measured approach and longer-term perspective is critical at this time. Crucially, the trick for investing success is to generally go against the crowd. This chart takes us back to March 2009 and the bottom of the current bull market, and imagines 3 investing paths. Number 1, staying invested in the light blue. Number 2, staying out of markets before investing back in 1 year later in the darker blue. And in green, staying in cash completely. It seems to be a time in the cycle again where we need to be very careful in our actions. The temptation to seek shelter is behaviorally natural, but often results in adverse outcomes. Our message is simple. Keep your eyes over the coronavirus horizon and fixated on your investing goals. Invest smart and often, letting the power of compounding and dollar cost averaging take you steadily closer towards your goals. We leave you today with 3 key takeaways. Number 1, market volatility is normal, but nonetheless unsettling. The 4th quarter of 2018 was less than 18 months ago, when the US market fell by 20%. In most cases, market corrections are healthy and create the mechanism for prices to better reflect fundamentals and allow the next phase of the market upturn. Number 2, rebalancing is our usual practice after large price movements to maintain the target asset allocations in our portfolios. The recent price moves have caused us to rebalance most of our multi-asset portfolios by selling bonds and buying back into stocks, taking us towards our dynamic medium-term targets. And number 3, we are continually assessing buying opportunities brought on by the declines. But most asset classes and stocks haven't yet lost enough to become attractive to move to an overweight position. We will continue to keep investors abreast of our actions and research, but until then, we hope you found this insight useful and insightful.
Expand your investing horizons and look to the long term with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. And lastly, Dan Wasiolek explores travel firms' value beyond coronavirus.
Since late February, the global pandemic coronavirus has spread to areas outside of China and is now set to materially impact travel companies in 2020. For our hotel and online travel companies, we currently model that global travel demand is down around mid-teens in 2020 before seeing a near full rebound in 2021. This forecast is really driven by what we saw in 2003 with SARS, where global travel demand in the first half of 2003 was down anywhere between 10 and 15% before stabilizing in the second half of the year, and then in the following year, in 2004, seeing a good rebound in growth. Now, geographically, it's tough to handicap, what regions are expected to see stronger declines in traffic demand. Currently, we expect that North America sees declines of mid to high single digit in total travel demand in 2020, whereas Europe sees around 10% declines, and the rest of the world, such as Asia Pacific, sees the most severe declines of 25%. That being said, I think there's an opportunity for long-term oriented investors as there's a lot of value in the companies that we follow. For example, in an online travel, Expedia, TripAdvisor, and Booking hold strong network advantages. And within the hotel area, companies like Marriott and Hilton have brand and tangible asset advantages, all of which we think are going to stay well intact once we do reach some containment and stabilization in the environment.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you've enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@Morningstar.com. From everyone here at Morningstar, thanks for listening.